AI is starting to change how I think about investing. For the past few decades, one of the simplest and most successful strategies has been investing in an S&P 500 index fund. Historically, it has returned around 10% per year on average, and the idea is simple. Instead of trying to pick the best stocks, you simply buy a small piece of the 500 biggest companies in America. That way, even if some companies fail, the overall market continues to grow. And honestly, this strategy has worked incredibly well for millions of investors. But recently, after studying the rapid growth of AI and how it's affecting the stock market, I started making a few changes to how I invest. Today I want to share 5 important shifts I'm making because of AI. 1. Rethinking the S&P 500. The first thing I realized is something many investors don't know. When you invest in the S&P 500 today, a huge portion of your money goes into just a few companies. Companies like Nvidia, Microsoft, Apple, Amazon, Meta, and Tesla now dominate the index. In fact, the top 10 companies alone make up about 40% of the entire S&P 500. And most of these companies are spending massive amounts of money on artificial intelligence. Now AI could absolutely transform the world, but here's the concern. Many of these companies are being valued based on future expectations, not just current profits. Investors are betting that AI will generate massive revenues in the future. And if those expectations are too optimistic, the market could be forming an AI bubble. So instead of relying entirely on the S&P 500, I started thinking about diversifying more globally. To investing beyond the US. For the last decade, the United States has dominated the stock market. But history shows something important. No country stays on top forever. At the start of the 1900s, the United Kingdom dominated global markets. Later on, many investors believed Japan would become the world's economic leader. But eventually, the leadership shifted again. That's why I'm increasing my exposure to global markets. There are incredible companies around the world, from semiconductor manufacturers in Asia to major industrial and technology companies in Europe. By investing globally, you reduce the risk of relying on just one economy. 3. Looking at smaller companies. Another opportunity I see is in small and mid-sized companies. Right now, most investors are focused on the biggest AI companies. But sometimes the real opportunity isn't in the companies building the technology. It's in the companies using it in smart ways. Smaller businesses can adopt AI tools to improve efficiency, reduce costs, and create new products without spending billions developing the technology themselves. And historically, smaller companies have often delivered higher long-term growth than large corporations. That is why I am starting to pay more attention to the underdogs of the market. 4. Hedging with gold. Another shift I'm making is increasing my exposure to gold. Gold has always been seen as a store of value, especially during times of uncertainty. And recently, central banks around the world have been buying large amounts of gold. Why? Because major technological shifts, economic tensions, and global competition can create instability in financial systems. Gold acts as a financial insurance policy. It's not something you go all in on, but holding a small portion can help protect your wealth during turbulent times. 5. Holding more cash. The final change I'm making might surprise you. I'm holding more cash. One of the biggest mistakes investors make is not having enough liquidity. When emergencies happen, people are often forced to sell their investments at the worst possible time. Even legendary investors understand this. In fact, Warren Buffett is currently holding hundreds of billions of dollars in cash. Why? Because when markets crash, cash becomes extremely powerful. It allows you to buy great investments at discounted prices. Final thoughts. The truth is, nobody knows exactly what the future of AI will look like. AI could lead to incredible growth, or it could create bubbles in certain parts of the market. So instead of trying to predict the future perfectly, my strategy is simple. Keep investing in strong companies, diversify globally, look for overlooked opportunities, hold some gold, and keep enough cash ready for market downturns. Because the smartest investors don't try to guess the future, they prepare for multiple outcomes. If you enjoyed this video and want to learn more about investing and building wealth, make sure to subscribe, and I'll see you in the next one.